In this session, we will be dealing with different concepts related to national income. Okay, so we need to start with gross domestic product, and our aim is to reach to net national product at factor price. So as you can see in this slide, I have highlighted different words in each concept, right? So I've highlighted in the first gross domestic product concept, I have highlighted in red gross, and net domestic product I have highlighted net with red, right? So uh, we will first need to understand what is the basic difference between these concepts. What is the difference between these highlighted words first, and then we will move over to the whole concept later. Okay, so highlighted words are like gross and net, domestic and national, market price and factor price. We need to understand what is this and how to convert one concept to another concept, which will make us uh, easy to understand the whole concepts at different levels, right? So we will start with gross and net, right? Gross and net, you know what gross and net is. The basic difference between gross and net is depreciation, right? Gross is the value of product including depreciation, and net is where the value of product is excluding depreciation. So when it comes to national income, the last aim is basically national income is net national product at factor cost. You can say that it is net concept which doesn't include depreciation. So what is depreciation? Depreciation is fall in value of all the tangible assets. How is it happening? Why is that value of some of the assets are reducing throughout the years? Right? It can happen due to wear and tear, because you have been using it for so many years. There will be wear and tear, a reduction of value. Accidentally, you have met with the accident. Suppose I'm giving you an example for that. You bought a bike in 2015, and the actual price that you paid at that point of time is 1 lakh. That actual price is what we consider as gross, right? And you have been using it, there will be wear and tear. You might have met with accident which may also have reduced the value of the bike. Passage of time, because it's 2015 you have bought that bike and right now it is 2021. Time has been moving, and technology is going to be absolute, right? Absolence technology basically means that initial days we had black and white TVs, right? If we are trying to sell that black and white TV right now in 2021, what will you actually get? The value of that asset or value of that product has actually gone down. Nobody wants it. It's not updated one, right? So the initial price, the actual price at which you have bought the commodity is what we consider as gross, which doesn't, which actually include depreciation. So when you're selling at in 2021, you cannot expect that the same one it to be sold at same 1 lakh. Will we get 1 lakh when we sell it in 2021? No. So suppose you're selling it at 30,000, that 30,000 is considered as net. The present value, the selling price, now what is the price of that commodity, now what is the value of that commodity is being considered as net. This difference between, you can see that from 1 lakh it has reduced to 30,000. So that reduction in value, that value, how much of money has been reduced because of, it can be because of wear and tear, it can be because of accidental loss, it can be because of passage of time, or the technology has completely been outdated. All these things, this difference is basically 70,000, which is considered as depreciation, right? So gross, from for converting gross to net, we have to actually reduce depreciation. So all we have, any kind of commodity, we know that national income is basically the monetary value of all final goods and services. So now what we have in our hand is gross value. For from that we need to deduct depreciation so that we can know what net national product is, or what national income is, what is the present value we can understand, right? So as I explained, this is what is depreciation. You can say there is decrease in market value of assets, houses, uh, your wealth, your car, your all your fixed assets, can tangible assets can decrease, have a decrease in their market value, right? So another concept which was highlighted was domestic and national, right? So the basic difference between domestic and national income is net factor income from abroad. We said that Pigu actually considered net factor income from abroad in national income, right? So which is basically NFIA. Now what exactly is NFIA? How can you find out net factor income from abroad? Net factor income you can find out by factor income from abroad, FIFA, minus factor income to abroad, that is FITA. When we deduct these two, we will get net factor income from abroad. That basically means income earned by a normal resident from abroad. A person is working abroad, he is working from there and he is earning income which is being sent to our country, minus an income earned by non-resident from domestic territory. Someone who is staying in India and earning from India, who is not a resident of India, income earned by him has to be deducted with income earned by an Indian who is there in the abroad, which will give us net factor income from abroad. Okay, so to convert domestic to national, we need to add net factor income from abroad. That is how we convert domestic to national. I can explain it with an example. Okay, Zen. Zen is from China. He is in India right now. He is working in India and he is earning 2000 rupees. Okay, I'm considering all the income in rupee to avoid confusion. Kumar. Kumar is a person who is actually an Indian but residing in US and earning money equivalent to 5000 rupees. How to find net factor income from abroad? So basically Zen, who is a non-resident but staying within the territory of India. So he is earning income factor income to abroad. So whatever he is earning is been going out of the country, that is 2000. Kumar, who is staying outside India and earns that 5000 and send that 5000 to his family back in India. That is FIFA, that is factor income from abroad. So income is coming from abroad from Kumar, and income that is going out of the country to abroad by Zen is being deducted. So 5000 minus 2000, 3000 is the actual amount we consider as net factor income from abroad. Whoever is there in the country, their money and the money which has been sent to the country by the non-residents as in the form of remittance. So this formula the concept also has to be understood. The formula net factor income from abroad, we can find it out from factor income from abroad minus factor income to abroad. So national income, if you have to find out national income, we have to add net factor income from abroad. And we have to find out domestic income, that means we have to deduct net factor income from abroad. Clear? Moving over to the next, this is a pictorial representation of how domestic and this works. Right, we will come to it. This is basically, see, in India, whatever has been produced within India is being considered as domestic. Right, even Zen's money is being considered. That we will come to GDP later on. Okay, and this is like how suppose there are companies like our own companies like Tata, Infosys, HCL and Indian Oil out of our country, working in some overseas land and sending back money into the country, we will take, that is considered as factor, right? Factor FIFA, right? Factor income from abroad. That will also, we will deal with this in detail when it comes to the concept. Next concept is market price and factor price. Right, market price and factor price. First we will start with factor price. Factor price is basically what is the cost of production. What is the cost of factors of production? We have 4 factors of production, that is land, labor, capital and organization. And what do we pay for them? We pay rent to the land. Labor, we pay them wages or salaries. Capital, we pay them interest. Organization or entrepreneurship's skills, we pay them profit. So this is factor cost basically. Factor payments, like we have seen in the circular flow, when we give them factor of production, they pay us back in factor payment. So that factor cost of these factors of production. is what we call factor cost. What is market price? What is the actual current price of final goods and services in the market is considered as basically market price. What is there written on the product? Right, you take a product, you can see that the price what is written over there is what we consider as market price. So all we have in our hand when we calculate national income is market price. So we need to know their factor price to come to national income, because we know that national income is NNPFC, so which is national income is actually calculated on factor price. So we need to get it right. We just have market price with us. We need to get factor price. And how to do that? Difference between market price and factor price is net indirect tax. How to get net indirect tax? There will be indirect tax and subsidies. Indirect tax minus subsidies is what we consider net indirect tax, which has to be deducted from market price to get factor price. Right, suppose we need market price and all we have is factor cost, then we can add net indirect tax. Okay, further we can explain it with an example. So I'm considering factor price as factory price. Okay, so factory price after paying rent, wage, interest and profit and all, it comes to 2000. That is how the product is coming out of factory, 2000. Of course government is going to tax them. You can't can you sell the product exactly at 2000 in the market? No, you might have seen in almost all the products that there will be inclusive of all the taxes. So 500 is being taxed. When they tax, government also provides some kind of discounts in the form of subsidies. Subsidy is 300. So to get market price, what we do? We add NIT. Right, because we have factor price with us, we need to add NIT, which is 500 minus 300, which we get 2200. Right, so NIT is the difference between market price and factor price. What we have in our hand basically at the time of calculation of national income will be factor cost. So how to convert it factor cost to market price? Deduct net indirect tax. How to get net indirect tax? Indirect tax minus subsidies, which is being shown in a picture. Right, first one, factor cost, that is here the product is a car where all the different factors of production, you can see that there is factory cost is there, raw materials, all the capital, labor, all these things, how much are they being paid, machineries are there. What are the costs for these factors of production is considered as factor cost. And market price, you can see at the end of the time, at the end of the line of supply, you have the product inclusive of all the taxes, which comes as market price. So market price will be always higher than that of factor cost. Right, so we need not include all those things, because at the same time government is also providing subsidies too. So when you calculate national income, we need not include that. That's why we are deducting it. Okay, so these are the three major things, from gross to net, domestic and national, and then comes factor cost and market price, which has to be very clear before we go into the